I'd like to start our webinar today on thinkstep-anz Spend-Based Emission Factors and how you get started with reporting and simplify some of the complexity in Scope 3 accounting. I'm going to be the host of the webinar today. My name is Jeff Vickers. I'm Technical Director at thinkstep-anz, and I'm joined by my colleague Katarina Balk, who's our Head of Carbon. I'm going to be taking you through some of the questions about what our emission factors are, what spend-based accounting is at a general level, and Katarina will take you through some more of the practicalities of how you use these types of emission factors in your day-to-day work. We want to cover the specifics of what our spend-based emission factors for New Zealand are. We want to cover timelines around when they'll be released for the 2026 year. So we already have the 2025 version out, but we'll be releasing the 2026 version later this year. We'll talk about timing. And then Katarina is going to go through use cases and lessons learned from applying these kinds of emission factors in carbon accounting. I'm going to talk at the sort of higher level about what spend-based accounting is and what our methodology is and the emission factors that we publish. So at a really, really high level, spend-based accounting, it's providing an emission intensity per dollar spend in a particular category. So it's what is the emissions of buying, a car or buying textiles or buying insurance, and it has the advantage of really making accounting quite simplistic and quite easy, but there's a few challenges there as well, which we'll kind of cover here. So the advantage of spend-based accounting is that it covers everything in the economy. It's complete. The challenge that we have is that, it's not product specific, and it does represent an industry average. So one of the challenges that we often see is that when you're talking about applying spend-based accounting, there's always this challenge of what price do you pay to get any particular product, right? So you can buy one particular product at a particular time. You can buy the same product discounted, 2 weeks later, and you're going to get an emission intensity for the product that was more expensive that's higher just because you paid more for it. And that's one of the inherent limitations of spend-based accounting. The other one above that, it's not product specific. The emission factors are always for categories, right? So it's like the category of buying a car. It's not the emission factor specifically for a Toyota or specifically for a BMW or specifically for a BYD. It's just the emission factor for that particular product category in the accounts. The advantages, just to cover those again, is that they're very, very easy to use. You just multiply by how much you spend. The advantage is they're covering absolutely everything that you spend money on. So they're covering products, but also services. And then they have the other advantage that a lot of other emission factors don't, is that they're complete by definition. So all money that we spend on buying things in the economy flows through. It flows through all levels of the supply chain. And so we capture everything. So all of the services are included, but absolutely everything that's got a dollar value in the economy is captured. That's something that's quite an advantage over other types of emission factors where you might take a more sort of detailed approach, and you then typically have some kind of system boundary or cutoffs where you can't account for everything. So these types of emission factors have the advantage of completeness. In terms of when you use them, we find there to be typically three main cases where they're really, really useful. So they're really useful when you're just getting started. It sounds like a lot of the people in this room are already well past that stage, so we won't cover it in detail. But when you don't know what your emissions are, spend-based emission factors help you to get to an estimated inventory really, really quickly so that you can work out where to focus your time. They're also useful for ongoing tracking because they provide a kind of consistent methodology through time, and they enable you to track how you're performing. The main issue with them is that you can't then determine whether we're improving or not, because the only thing you can do is spend less money or spend in other categories. So typically what happens with most companies like yourselves, when you're more progressed down the pathway, you tend to use a hybrid approach. And so spend-based emission factors are still really good for gap filling, the things that are maybe not the most material to your inventory, but they're still important and part of it, and then potentially replace some of those emission factors with activity-based data, supplier-specific data from your suppliers for the things that matter most. One of the things that's really important when you're doing that is just to think, if we are changing our methodology, you may also need to update your baseline year, so re-baseline, so that you're making a fair comparison, because just moving from using a spend-based factor to not using one isn't enough to be, hey, we're achieving an improvement, because the reality is you've kind of made a methodological change there. So that's just something to keep in mind. But increasingly what we're seeing is companies moving towards these hybrid approaches, and potentially a lot of people on this call are doing that. So what are our emission factors? They're a set of they're a data set effectively that we supply in Excel format and also through a report that we prepared. Those emission factors are there to help you to calculate your emissions really quickly in the New Zealand context. They are really quick and easy to use. The intention of them and the design of them is that they are specific to New Zealand. So a lot of you may be familiar with other emission factors out there like EURA or XIO-base or CEDA, the other kind of global methodologies that exist for accounting, some of which do capture the New Zealand context. I think a key thing with something like our emission factors is they're very, very targeted to the New Zealand market. So they're very focused on the data that is produced in New Zealand for use by New Zealand companies. So we rely heavily on data from the Ministry for the Environment, from Stats.NZ, that's published annually or semi-annually, and we're as close as possible as we can be to that domestic data that's coming from New Zealand itself. A lot of the other global methodologies, they might also cover New Zealand, but they're looking at it from the perspective of, hey, we're using OECD data or World Bank data, and it covers many, many different countries, and there might be already some degree of homogenization that's taken place to be able to get to that kind of consistent level, and they're just slightly further away from the kind of the raw data for the country itself. So it's not to say that one thing's good or bad, it probably just depends on what your use case is, and if you're a kind of global multinational, those other global metrics may be more appropriate. If you're more of a New Zealand company or Australasian company, then these might be more useful to you. So what are the differences between the different licenses that we offer, and which licenses do we offer? So we have a free version, which is publicly available on our website. You can download. It has both a PDF document and an Excel file. It covers the 2018 and 2021 reference years. It covers emission factors for industries and commodities. We've had that methodology peer-reviewed for both the free and the commercial version. But when you look to the commercial one, you can start to see there's a few more ticks down here, as is often the case with these kinds of diagrams. We took the commercial version through an audit process last year, and we'll do the same again this year. When you're looking at these dates, you'll see that they don't say 2025, 2026. The reason for that is we're always dealing with data that has a 2-year time lag, and I'll come to some of that in a minute. So the data set that we currently have is actually the 2023 version in the commercial license. The 2024 version will be released this year on the 31st of July, and that's our 2026 release. So we'll talk about that a little bit in a second, but I don't want to dwell on that for now. Some of the key differences between the free and the commercial version are just that we've got a bit more there for you. So you can integrate these emission factors into a software tool. So say you were using BraveGen or something else, you could put those emission factors in there. We provide a certain amount of customer support with every commercial license. So if you've got questions, particularly around mapping or how you map, we can help to answer those. We also provide an annual update. If you continue with the license, we provide new emission factors every year, which is not something we're doing with the free license. There's also the ability to do a few more adjustments within the tool, the Excel tool, if you've got the commercial license. So both tools we have will allow you to adjust for inflation and for GST, but the commercial license also allows you to adjust for the carbon footprinting method that you're using, so IPCC AR4 or AR5 or AR6, and then the commercial version also allows you to split emissions by scope and by the type of greenhouse gas that's being emitted. In terms of how the tool looks, for those of you who have seen it, it looks something like this. If this is new to you, then effectively what we've got here is we've got the different codes. These particular emission factors are for industries in the NZ SIOC classification. If you scroll down in the same tab, you'll see the ones for commodities. We've got the industry code there, we've got the industry name, and then we've got the emission factor and what is the adjusted emission factor. So in this tool, the adjusted emission factor is just allowing you to change which year you're trying to get the data to represent. So it'll do an inflation adjustment, and you can also turn off or on whether GST should be included or excluded. And you can see the adjustment factors that are being applied are appearing here, right? So it's telling you what the original is. In this particular case, it might be for 2021 in basic prices, and we're adjusting it to 2024 in basic prices. And so it shows you some of the differences here that are being applied. And this has got including versus excluding GST. So it's making 2 adjustments. If you want to download these, the free version, you can go to our website here and you can have a look at any time. I mentioned before commodities and industries. It's worth just kind of describing briefly what those things are. So we provide emission factors for industries, which are in basic prices. Basic prices you can think of as kind of like a farm gate or factory gate type price. We also provide commodity level emission factors in both basic prices and purchasers prices. Purchasers prices are at the wholesaler or retailer. They include the markup that's applied, the transport to get it to the retailer or the wholesaler, and in our emission factor set, they also include GST and purchasers prices, but you can choose to exclude that inside the Excel file. This year, we're launching a new license type, which is an auditor license. This will be freely available to all people who are reviewing and auditing others' work. If you'd like to apply for that license, you can go to our website and do that. And that's just something that we want to make available so that if you are a user as a company of our commercial emission factors, that your auditor can see the exact same license that you're using with the same up-to-date information, just to make that more transparent and to support the review process. In terms of when we release things, we aim for a release every year on the 31st of July. I know that timing kind of sucks for a lot of you because reporting season is often now. The reason for that is that we're relying on data from Statistics New Zealand, which is typically published on the 30th of May. And it takes us a while to do the transformations that we need to do and to get that audited each year. So we say 2 months from effectively the end of May is our release cycle. So that's the reason for it. What that means is if you've got a reporting cycle that is now, you're going to have to use the current version, which is the 2025 version. If you can wait until the 31st of July, fantastic. You can use those emission factors if you want to. But yeah, just to say that we won't probably be able to get them out before that because we're reliant on other data that's being published. One thing I would say though is that we try to keep the commodity and industry codes consistent through time so that it's easy to replace one with the other should you need to. So that you can just drop in if you need to. Okay, so just to say, here is the emission factors, and if you want to, we've got a discount code available on our website, which is valid through to the 30th of April if you do want to buy them. Okay, I might hand over now to my colleague Katarina Balk. So Katarina, over to you.
Thank you for the introduction, Jeff. And as Jeff mentioned in our last webinar, we looked at some typical use cases. And what I want to do today is focus on one of the use cases that I actually see the most, which is using spend-based emission factors for your supply chain or Scope 3 reporting. And I will be sharing some key lessons and some common challenges that we have seen by working with companies using spend-based emission factors. And one of the questions we hear a lot when companies getting ready to start with it, or even after a while, if they maybe want to adjust or improve some of the approaches, is how do you best assign the spend-based emission factors to your actual spend data? And what we see most commonly used are kind of two approaches. So companies usually map either by supplier or by general ledger codes, GL codes. And it's really for you to choose the approach that best fits your data, aligns with other internal practices that you have already in place that you're using. So for example, if you are looking at setting a target following SBTI and want a supplier engagement target, maybe it makes more sense for you to look at your suppliers. But most commonly, we actually see GL codes used. Reason for that is that they already exist in your financial reporting. They're generally quite reliable and they reflect the actual type of spend. So you might have two suppliers providing you different products, such as flight bookings and hotel bookings or cleaning and maintenance services. With the GL codes, you see the difference and you can assign the right emission factor to it. We also see hybrid approaches there, and that's quite often when companies improve over time as well. Let's say you start with the GL codes, but then you start conversation with your suppliers and see if they can actually provide you maybe some spend-based emission factors. And for that, if you have the GL code waste, spend on waste, but you have 3 different waste suppliers, you might want to break this down into the 3 suppliers so that you can then, when you talk with the individual suppliers, replace some of the dollar spend values with the actual emissions with them. So once you decide how you want to assign your emission factors, the next step that is quite important is actually cleaning your data that you're using. So in case you use GL codes, you want to go through and remove items that are not related to emissions. such as intercompany charges or employee salaries. For example, for us as a company that is a services company, we don't produce any materials. This is quite a large component of it. So taking those elements out, because everything we're doing as employees is already covered in other scopes and categories, such as electricity we're using, computer equipment, how we go to work. And then aligned to that, you also want to check, is there anything in your GL codes that you already cover in other scopes and categories? Your electricity spend, you already report that kilowatt hours under scope 2, or you get data from your waste suppliers, specific emission factors, so you can take that one out of your spend. And cleaning your GL codes is a way to ensure you don't double count emissions. And this is also a question we quite often receive from auditors, is how do you ensure that you're not double counting anything within your scopes and categories? And by having a process of how you go through this, how you approach it, how you make sure where it is counted, and have that documented, that helps quite often answering these audit questions as well. Once you have a clean list of your GL codes, you start usually by focusing on your top spend. And quite often you see kind of an 80-20 split, where really a small number of categories account for the majority of your spend. And this is where you should focus your effort on. So try mapping those 80%, it might be 90%, it might be 75% for you, of high impact areas, large spend, quite exactly to your emission factors. And then for the remaining 20%, you can use a simpler approach. The remaining 20% are often a large amount of small suppliers with low individual impact. And in this case, it's like using an average emission factor that you derive from your top 80 spend is a practical way to reduce the effort, the time you put into it. And what we quite often recommend is like mapping your 80%, then looking at the emission factors you use there and generate your own average that you then apply to your 20%. So don't look at the whole commodity list that we have in our emission factor data set, but look at the ones that are actually relevant for your 80%, most likely apply to your 20 as well. And it's important to remember that auditors as well, they don't expect like perfect precision. They are looking for reasonable, well-justified assumptions. And the key is materiality here. So like focus what most affects your scope 3 emissions, rather than spending too much effort on some of those low impact areas. Another thing that's quite important for you going forward, doing it again, handing it over to someone, but also for the auditors, is that you start by clearly documenting why certain spend categories are excluded or where else they are included. Document your approach for mapping spend emission factors to your spend categories, especially if you have multiple options that you could use. And then make sure you apply the same thing across all categories, all business units. Use the same association for different business units. Again, focus on materiality, spend with high emissions, high spend, focus on that one. That was auditors after as well. So they look at materiality, they want to see a clear methodology, a consistent approach that you are applying, nicely documented. And then for emission factors, what we are seeing is that they are quite often following, I think it's listed in the GHG protocol, it's in other latest disclosures, guidance and standard that's out, that it is a transparent methodology that they can actually review, but then also it is specific to the location that you're operating in, if possible. It's regularly updated. And then quite often we receive the question now as well, if emission factors are somehow reviewed, if that's reviewed, peer-reviewed, audited, that might differ, but it's quite often the question that comes up is that, are the emission factors somehow double-checked? The last thing I want to cover is the time budget for this work. Yes, in the first year, there is more time that you need to define your inclusions, exclusions, map your GL codes. But in the following year, as Jeff said, these GL codes usually don't change. So you can reuse your established rules and your mapping, perform some spot checks, check materiality is still the same, but otherwise it's quite consistent. Once you mapped it, the factors change, usually the categories don't, unless of course you buy something completely new. If there is a large change, we try to keep it consistent for you, or provide a mapping so that it actually helps you bring those two things together if there are significant changes. One thing to note for audit, we had it a couple of times that everything was ready for audit. It went to the auditor, and then the latest emission factors were released. So if you are on close to some of these cutoff dates, ours or some others, it's good having discussion with your auditors about this, because quite often the auditors then wanted the new emission factors to being implemented. Again, it shouldn't take too long, but just so that you're aware of it and factor that one in. Just quickly to wrap this up, use an approach that fits to your data and aligns with internal practices. Don't invent anything new. Try to use what you already have. Clean your data to avoid double counting. Focus on materiality. Document everything that you're doing. And that when you do it, like right in the first year, it will save you a lot of time in the following years.
Thank you, Katarina. So we've had a few questions come in. I'd encourage you to put some more in if you'd like to. So the first question we had was from Jamie. So does ThinkStep, or would ThinkStep consider publishing more specific methodology for each emission factor? So there's been some that you've used in the past that don't quite look right. So an example was an emission factor for flights, for example. I think one thing that's worth keeping in mind is that the calculation methodology is kind of the same no matter what the environmental indicator is. And so one of the things is that we have to use, or at least we don't have to use, but we do use the information that's provided by Statistics New Zealand for a particular category. And sometimes that information might look a little bit strange to us as well. And there's only so much we can really do about it. Like, we'll correct it if we know it's wrong, but if we don't 100% know it's wrong, we may just leave it as it is, and potentially we could do more to document where there are sort of issues. For something that's like flights, where it's a really fuel-intensive activity, I'd encourage you to use specific emission factors from your suppliers wherever possible. So if it's flights, if it's freight, if it's things that are really, really fuel-intensive, my view would be that it's really better to go to your suppliers and ask for that information. Generally, they can supply it easily now, and it's always going to be more reliable because they can factor in so many different things that aren't just how many dollars did you spend. There's so many problems with discounting, with whether we're talking about domestic versus international aviation, with business class versus economy class. There's like just a whole raft of issues there. And so if possible, I'd say for those really emissions intensive things that are heavily linked to fuel, I'd encourage you to use a kind of an intensity metric that isn't by dollars. The next question we have is from Brian about our emission factors and whether they work well for Australia. The short answer is no, and I'd encourage you to use an Australian specific set of emission factors. One that you can look into is look at Footprint Lab. They make available the IE Lab Australian emission factors. We can also connect you directly with them if that would help. So they make some specific ones available for the Australian market, or you can use one of the kind of global sets like XIO-Base or CEDA. Just to say thanks again to Katarina, and also to give a little plug to some of our future webinars. So we do have a webinar coming up next month, on the 15th of April, which is about Tetra Pak's life cycle assessment, looking at LCA of packaging. And then we've got another in-person course coming up from Insight to Impact, which is a one-day applied LCA course in Sydney on Tuesday, the 12th of May. And we've got a few things coming up in our pipeline regarding our material circularity indicator tool and our new disclosure kit tool to help people with compliance in the Australian market for financial disclosures. So I haven't seen any other questions coming in. So with that, we're going to wrap up, and thank you all very much for your time. Have a great day. Thanks. Bye.
We have many more webinar replays on a whole host of sustainability topics. You can check them out on our website and our YouTube channel.